Hey everyone, welcome back to Canada Accounting Insights. I'm glad you're here. Notes receivable might look simple on the balance sheet, but the way you measure and account for them can vary a lot depending on whether you're following IFRS or ASPE. In today's video, we're going to break down exactly how notes receivable are handled under IFRS 9 and ASPE 3856 step by step. By the end, you'll not only understand the rules, you'll also see why they matter for exams, practice, and real-world decision-making. But before we dive into today's topic, don't forget to hit that subscribe button and leave a like. It really helps the channel grow and makes sure you don't miss any new videos. Alright, let's start with the basics. Before getting to the numbers, let's make sure you get a rock-solid foundation by defining what notes receivable actually is. A note receivable is essentially a written promise from a borrower to pay back money at a future date, usually with interest. It's different from accounts receivable because notes often carry formal agreements, longer terms, and explicit interest. On your daily life or even on your CPA exam, whenever you see a company selling goods, providing services, or even loaning money and receiving a signed note, you need to stop and ask, how should this be measured? Okay, now you know the difference between accounts receivable and notes receivable. But how to initially recognize it in the books? Notes receivable are initially measured at fair value plus transaction costs. Fair value is defined as the present value of future cash flows, discounted at the market interest rate. That could be either the borrower's incremental borrowing rate or the rate implied when the cash price of a sale is known. So from day one, you bring the receivable onto the books at what it's actually worth in today's dollars, not just the face value. Let's start with the dream scenario, the one that we all hope to see. This is when the interest rate written right on the note, we call that the stated rate, just happens to be the same as the market rate for a similar loan. When these rates match up, the accounting is just beautifully simple. The face value of the note is its true economic value, so you just record it for that full amount. Easy peasy. But it's not always easy like that, right? So what happens when those rates don't match? This is when the real accounting happens. Well, we can't just record it at the face value anymore. Instead, we have to record it at its present value, using the market interest rate to do it. So, how do we find that present value? We can use either the Excel formula or the financial calculator. These 5 inputs are your best friends. You just need to figure out the number of periods, plug in the market rate for I over Y, the payment, the face value, and then solve for PV, the present value. Let's walk through a classic example, a non-interest-bearing note. The state rate is 0, but the market expects to earn 7%. Look at our inputs. We got a present value of $18,070, and the $430 difference is an immediate loss. So that's day 1. The note is officially on our books. But what happens next? As time takes by, we earn interest, and we need to account for that. This is what we call subsequent measurement. After initial recognition, notes receivable are measured at amortized cost. That's calculated as the original amount recognized plus interest to date, using the effective interest method minus any payments received. And here is how we calculate the effective interest method. It's calculated by taking the note's book value, its carrying amount, and multiplying that by the original market rate. Let's stick it in your mind, walking through a scenario and how it's calculated by using an amortization table. This keeps the carrying value aligned with the economics of the agreement. And remember, under IFRS, you must use the effective interest method, no shortcuts here. What happens when the note is settled, sold, or otherwise removed? Both IFRS and ASPE require derecognition when the rights to cash flows expire, are collected, or when the receivable is transferred and substantially all the risks and rewards pass to another party. Now let's shift gears to ASPE 3856 and see some differences on how notes receivables are treated under this gap compared with IFRS. The logic is similar, but there's a big difference in how interest revenue can be calculated. Under ASPE, you can use either the effective interest method, same as IFRS. Or the straight line method. That straight line option makes things a little simpler, and it's one of the ways ASPE is designed to reduce complexity for private enterprises. So let's put it side by side. IFRS must use fair value initially, must apply the effective interest method going forward. ASPE, fair value concept still applies, but you have the option to use straight line amortization for interest. That might sound like a small detail, but it can lead to different reported interest income, especially for longer-term notes. Let's work through a quick example. Suppose a company issues a 3-year, $100,000 note receivable with interest at 4%, while the market rate is 6%. Under IFRS, you'd initially measure the note at the present value of cash flows discounted at 6%. That means the receivable comes in at less than $100,000, and over time, you accrete the difference using the effective interest method. Interest revenue will be based on the market rate, not the coupon rate. Under ASPE, you could do the same calculation. But if management chooses, they could just use the straight line method, which spreads the discount evenly across the life of the note. Simpler, yes, but less precise. To sum up, notes receivables are measured initially at fair value plus transaction costs. Under IFRS, subsequent measurement is always at amortized cost using the effective interest method. Under ASPE, you can use either effective interest or straight line. Derecognition rules are similar, but the presentation of income can vary depending on the method. So, whether you're studying for exams or analyzing real-world financial statements, knowing these differences is key. Okay, so why should we care? For CPA students, this shows up all the time in assessment opportunities. You might be asked to measure a new note, calculate interest income, or compare IFRS and ASPE treatments. For practitioners, the choice of framework can directly impact net income and equity. A company reporting under IFRS might show lower income in early years due to the effective interest method, while an ASPE company using straight line could show higher income at first. And for business owners, the difference affects how attractive your financials look to lenders, investors, and even buyers. Thanks for joining me on Canada Accounting Insights. If you found this helpful, hit like and subscribe, and share this with a fellow CPA student or colleague. And tell me in the comments, do you prefer the precision of IFRS or the simplicity of ASPE? I'd love to hear your thoughts. See you in the next video.